What if I told you the world's second largest economy is carrying debt 3 times bigger than America's entire crisis, yet still growing faster than almost anyone predicted? China has built a $50 trillion economic powerhouse while sitting on a debt bomb that would cripple most nations overnight. We're talking about corporate debt, local government debt, and hidden liabilities that dwarf anything Wall Street has ever seen. But here's the twist. While economists have been predicting collapse for over a decade, China keeps expanding, building, and dominating global markets. How is this even possible? The answer challenges everything we think we know about sustainable economics. If this intrigues you, smash that like button and subscribe, because what you're about to discover will change how you see the global economy forever. Let's dive into the most dangerous balancing act in modern financial history. China's total debt now exceeds 280% of its GDP. That's roughly $47 trillion in obligations for an economy valued at around $17 trillion. To put this in perspective, when the United States faced its 2008 financial crisis, total debt was around 250% of GDP, and we witnessed the worst recession in generations. Yet China operates under fundamentally different rules. Since economic reforms began in 1978, the country transformed from an agricultural society into a manufacturing giant through massive infrastructure spending, real estate development, and state-directed credit. Banks, which are state-owned, pumped trillions into projects that prioritized growth over profitability. Local governments created financing vehicles to bypass borrowing restrictions, accumulating mountains of hidden debt. Evergrande, Country Garden, and dozens of property developers collapsed under unsustainable leverage, yet the broader economy continued expanding. This isn't just about numbers on a spreadsheet. It's about a completely different economic model that defies Western financial logic. Usually, explosive debt growth and economic stability don't coexist, but when a government controls both the banks and the narrative, traditional warning signs get suppressed until the pressure becomes unbearable. The consequences are already unfolding. Youth unemployment hit record highs above 21% before authorities stopped publishing the data altogether. Millions of homebuyers paid for apartments that will never be completed because developers went bankrupt mid-construction. Regional banks are technically insolvent, propped up only by government guarantees and accounting tricks that hide non-performing loans. Retirees are discovering that promised pensions might evaporate as local governments run out of revenue from land sales, their primary income source for decades. The property sector, which represents nearly 30% of China's economy, is in freefall, with home prices dropping in over 70 cities consecutively. This creates a vicious cycle. Falling property values reduce household wealth, leading to decreased consumer spending, which slows economic growth, making debt burdens even heavier relative to GDP. Meanwhile, capital flight accelerates as wealthy Chinese move assets offshore, draining foreign currency reserves. The contradiction is stark. China needs consumption-driven growth to transition from its investment-heavy model, but crushing debt loads prevent households and businesses from spending. Together, these forces create a trap where any solution that addresses one problem worsens another, paralyzing policymakers. The good news? China has tools that other nations simply don't possess. But using them requires abandoning the growth-at-all-costs mentality that built this empire. Beijing could restructure local government debt through centralized bailouts, essentially transferring obligations from provinces to the national balance sheet where financing costs are lower. They could force banks to recognize bad loans and recapitalize them using foreign reserves, taking short-term pain for long-term stability. A massive wealth redistribution program could redirect resources from state-owned enterprises to households, boosting consumption while reducing reliance on debt-fueled investment. Some economists suggest letting zombie companies fail, accepting a temporary recession to cleanse the system. The challenge? Each solution requires political will to accept slower growth, acknowledge past mistakes, and dismantle powerful interests that benefit from the current system. It demands transparency that contradicts decades of opacity. But if executed decisively, China could transform this crisis into a new economic model, one less dependent on leverage and more sustainable for the long haul. While this crisis dominates headlines in Beijing and Shanghai, Its shockwaves are already reshaping economies from Germany to Ghana. China is the world's largest trading partner for over 120 countries, meaning any slowdown in Chinese demand immediately hits exporters worldwide. Australia's iron ore industry, which sends 80% of exports to Chinese steel mills, has watched prices plummet as construction projects halt. German automakers like Volkswagen and BMW, who generate nearly 40% of global profits from Chinese sales, are seeing revenues collapse as middle-class consumers delay big purchases. Developing nations across Africa and Latin America that borrowed heavily from China's Belt and Road Initiative now face a double blow. Their Chinese creditors are restructuring loans just as commodity exports to China decline, creating debt crises in countries like Zambia and Sri Lanka. Global supply chains, meticulously built around Chinese manufacturing, are being disrupted as factories close and credit dries up. The interconnectedness means financial contagion is inevitable. European banks holding Chinese corporate bonds, American pension funds invested in Chinese equities, and Asian currencies pegged informally to the yuan all face exposure. Perhaps most critically, if China dumps U.S. Treasury holdings to finance domestic bailouts, interest rates could spike globally, affecting everything from mortgage costs in Toronto to government borrowing in Tokyo. The geopolitical implications are equally profound. Economic weakness may push Beijing toward more aggressive foreign policy to distract from domestic troubles, raising tensions in the South China Sea and around Taiwan. No economy operates in isolation anymore, and China's size means its problems become everyone's problems, whether through trade disruption, financial contagion, or strategic instability. So how did the world's most carefully controlled economy accumulate debt that makes Western crises look manageable? What specific mechanisms allowed local governments and corporations to borrow so recklessly under a supposedly authoritarian system? Why have international investors continued pouring money into Chinese markets despite red flags visible for years? And critically, what strategies can Beijing realistically deploy to defuse this time bomb without triggering the social unrest that terrifies the Communist Party more than any economic indicator? Most importantly for us watching from outside, what does China's path forward mean for our jobs, investments, and economic security? Let's break down the mechanics of this unprecedented situation. Let's break down what's happening. First, understand that China's debt explosion stems from its growth model after 2008. When the global financial crisis hit, Beijing launched a massive 4 trillion yuan stimulus, but the real action happened at local levels. Provincial and city governments created thousands of local government financing vehicles, essentially shadow banks that could borrow without appearing on official budgets. These LGFVs issued bonds to fund infrastructure. High-speed rail networks, airports serving tiny populations, entire ghost cities with millions of empty apartments. Banks, all ultimately controlled by the state, had implicit instructions to lend freely because employment and social stability depended on construction continuing. Think of it like giving your teenager a credit card with no limit and telling them spending keeps the family happy. You've created incentives for disaster. Next, the property sector became the primary wealth storage for Chinese households. With capital controls preventing easy overseas investment and a volatile stock market, ordinary citizens poured 70% of household wealth into real estate. Developers like Evergrande borrowed aggressively, pre-selling apartments years before construction and using that cash to buy more land and start new projects, a Ponzi scheme disguised as business strategy. When Beijing finally tightened borrowing rules in 2020 through the 3 red lines policy, the entire model collapsed. Developers couldn't roll over debt, construction stopped, and homebuyers were left with mortgages on non-existent apartments. This created the mortgage boycott movement, where hundreds of thousands simply refused to pay loans for unfinished homes. Finally, the structural issue ties everything together. China's economy grew by channeling household savings into investment rather than consumption. The household consumption rate is only about 38% of GDP compared to 68% in the United States. This means Chinese families save excessively while the state invests those savings into projects with diminishing returns. Airports nobody uses, factories producing goods for shrinking export markets, luxury developments sitting empty. The debt isn't creating proportional value anymore. Every yuan borrowed today generates less economic growth than a yuan borrowed a decade ago, a phenomenon called declining marginal productivity of debt. You're working harder for smaller results, and eventually, the math stops working. The banking system amplifies these problems through accounting fiction. Non-performing loans are officially around 2%, but independent analysts estimate the real figure exceeds 15% when you include restructured loans, evergreened credit, and loans to entities that only generate enough revenue to pay interest, never principal. Banks survive because depositors believe the government guarantees their savings, a belief that's probably correct but has never been truly tested at scale. Shadow banking added another layer, with wealth management products offering higher returns than deposits, channeling money into risky projects while technically staying off bank balance sheets. When these products started defaulting, authorities had to choose between letting investors lose money or bailing them out, each choice setting dangerous precedents. Provincial government finances present perhaps the most intractable challenge. These governments relied on land sales for 30–40% of revenue, selling usage rights to developers who built the apartments creating the bubble. As property prices fall, land becomes worthless, destroying the primary income source for local governments already drowning in LGFV debt. They can't raise taxes significantly without triggering unrest, can't cut services without the same result, and can't borrow more because they're already overextended. Beijing faces a choice: bail out provinces and absorb their debt, or let them default and risk financial panic. Either option costs trillions and sets precedents for future behavior. We've seen echoes of China's crisis in Japan's lost decades starting in 1991, offering both warnings and potential roadmaps. Japan also experienced a massive property and stock bubble fueled by easy credit and speculation, with Tokyo real estate values briefly exceeding all of America's. When the bubble burst, Japanese banks held trillions in bad loans but refused to recognize them, keeping zombie companies alive through evergreen lending. The government prioritized social stability over economic efficiency, much like China today. The result? 3 decades of stagnant growth, deflation, and an aging society burdened by debt. Japan's nominal GDP barely grew between 1995 and 2020, despite massive government spending. However, Japan had crucial advantages. China lacks. It was already a developed, high-income nation with strong institutions, a homogeneous culture accepting of sacrifice, and security guaranteed by the United States, allowing it to avoid military spending while managing decline. China faces Japan's problems, but starting from middle-income status with 1.4 billion people expecting continued improvement. The historical precedent suggests that debt crises of this magnitude typically resolve through 4 mechanisms: growth, growing your way out by expanding GDP faster than debt; inflation, eroding debt's real value through currency debasement; austerity, cutting spending and accepting recession; or default, restructuring or refusing to pay obligations. China seems to be attempting a 5th path, extend and pretend, where authorities acknowledge problems slowly while using state control to prevent panic, buying time to distribute pain gradually over decades rather than in one catastrophic event. South Korea's 1997 Asian financial crisis offers another comparison. Korea had similar issues. Chaebols, family-owned conglomerates, borrowed excessively, banks were politically captured, and foreign currency debt created vulnerability. When the crisis hit, Korea accepted an IMF bailout with harsh conditions, let major companies fail, restructured its entire financial system, and emerged stronger within a decade. The key difference: Korea had democratic institutions that processed public anger through elections rather than fearing revolution, and its smaller economy meant international rescue was feasible. China's political system makes accepting outside help or acknowledging systemic failure nearly impossible without risking legitimacy. The Communist Party's entire claim to govern rests on delivering economic prosperity. Admitting the model is broken threatens their fundamental justification for power, creating political constraints that override economic logic. If we stay on this path, we're likely to see a slow-motion crisis rather than a spectacular collapse, death by 1,000 cuts instead of sudden cardiac arrest. Property values will continue grinding lower, destroying household wealth and creating a generational divide where older Chinese who bought early keep their wealth, while younger citizens face negative equity. Banks will remain technically solvent through government support but functionally paralyzed, unable to lend aggressively and support genuine innovation. Economic growth will slow to 2 to 3% annually despite official statistics claiming higher figures, as debt servicing consumes more resources that could drive productive activity. This Japanification scenario means China never experiences a cathartic crisis that forces reform, but also never returns to the dynamism that made it the world's factory. For ordinary Chinese citizens, this translates to stagnant wages, reduced job opportunities, and the collapse of the property wealth retirement plan that generations relied upon. The social contract, accept limited political freedom in exchange for rising prosperity, breaks down when prosperity stops rising. We could see increasing unrest, not in the form of organized political opposition, but through millions of individual acts of defiance, mortgage boycotts, tax resistance, capital flight, and refusal to participate in state initiatives. The surveillance state can suppress organized dissent, but struggles against widespread passive resistance. Internationally, a weakened but still enormous China creates dangerous instability. Beijing may pursue more aggressive trade practices, currency manipulation, or technological theft to maintain growth. Military adventurism could increase as leaders seek nationalist distractions from economic malaise. Taiwan becomes particularly vulnerable if Chinese leadership decides domestic problems require an external focus. The global economy fragments as countries reduce dependence on China through reshoring or friendshoring, raising costs and reducing efficiency built over decades. Developing nations trapped in Belt and Road debt face a generation of austerity as they service obligations to a creditor with no interest in forgiveness. Financial markets experience periodic panics as investors suddenly reassess China risk, causing volatility that affects everyone's retirement accounts and job security. Your everyday life feels this through higher prices, reduced investment returns, and geopolitical uncertainty that makes long-term planning nearly impossible. So, China built an economic miracle on foundations of sand, mountains of debt that enabled spectacular growth but now threaten to bury the very prosperity they created. The fundamental issue isn't just the debt level, but the model itself. Growth driven by investment and exports has reached its limits, yet transitioning to consumption-led growth requires accepting years of slower expansion that no Chinese leader seems willing to embrace. The world watches this high-wire act knowing that China is too big to fail, but also too big to bail out. Unlike previous crises, there's no international rescue package capable of addressing a $47 trillion problem, and China's political system resists the transparency and reform that typically accompany recoveries. We face a crucial choice, not China alone, but the global community. Prepare for a world where the economic engine that powered decades of growth sputters and stalls, or hope that authoritarian capitalism can somehow defy gravity indefinitely. History suggests the former is more likely, but the timeline remains uncertain. What happens next depends on decisions being made right now in Beijing's corridors of power, decisions that will reshape your economic future, whether you're in Shanghai or San Francisco. Thanks for watching World Economics Explained. Don't forget to like this video, share it with someone who needs to understand what's really happening in the global economy, and subscribe so you never miss our deep dives into the forces shaping your financial future. See you in the next one.